the company vanished. How did this happen? Nokia once ruled the world of handsets. Tens of billions of dollars of market value disappeared. Roughly 90% of its smartphone market presence was erased. Entire regions and thousands of jobs depended on its continued success. Then one public decision set a chain in motion. By the late 2000s, Nokia led global handset volume. Its Symbian operating system powered the majority of its smartphones. Symbian dominated the early smartphone OS landscape. That scale bought revenue. It bought supplier leverage. It bought a global distribution engine few rivals could match. Whole careers and national pride leaned on that scale. In early 2011, Stephen Elop, a former Microsoft executive who had become Nokia's CEO, issued a memo titled "Burning Platform." He announced a strategic switch. Nokia's smartphone future would be built on Microsoft's Windows Phone. The memo framed Symbian as obsolete. It declared a one-way course away from the platform that had made Nokia dominant. Inside Nokia, engineers, partners, carriers, and developers were instructed to abandon the known for an uncertain future. At first, momentum kept the story complicated. Symbian still produced substantial sales even after the memo. Nokia's retail footprint remained large. Early reviews of Nokia's Lumia hardware praised design and build quality. Investors and some partners briefly clung to the hope that Nokia's scale combined with Microsoft's software could produce a turnaround. Design teams and engineers worked frantically. They hoped a short-term sacrifice would buy a long-term return. Warning signs emerged quickly. App developers began to hedge. Carriers started to signal skepticism. Development on Symbian stalled as partners delayed new investments. The pipeline that fed retail demand began to thin. Product replenishment slowed. Carrier promotions weakened. Sales staff faced longer sales cycles and empty shelves. Morale slipped across the company. The losses escalated in stages, each worse than the last. The first stage was a measurable sales dip. Quarter-to-quarter Symbian sales dipped as retail confidence cooled. That dip tightened budgets. R&D initiatives were postponed. Sales teams reported fewer walk-in customers and longer conversion times. The second stage was a collapse of the ecosystem. Developers and app publishers reduced investment. The app ecosystem that modern smartphones required began to shrink for Nokia's platforms. Phones without a rich app catalog lost consumer desirability. Purchase deferrals accelerated. Product managers and developers faced career risk and began leaving for iOS and Android roles. The third stage was rapid market share erosion. Symbian sales collapsed ahead of Windows Phone availability. Retail and carrier partners reduced promotions and stock. Nokia's scale advantage evaporated in months. Supply orders from factories were cut. Layoffs began. Suppliers saw orders fall sharply. The company that had dominated the handset market found its distribution engine sputtering. The crisis stage arrived when Nokia's Windows Phone devices reached the market. They arrived months after the memo-driven collapse. By then, the Windows Phone ecosystem was immature. There were too few models to plug the demand hole. The strategic pivot had left a long, exposed gap. Nokia had lost customers and credibility without a ready replacement. The turning point was not a spreadsheet. It was narrative. The public framing of Symbian as a burning platform became the inflection. That single declaration changed how carriers, developers, and consumers treated the platform. Rather than a managed transition, the market treated the platform as terminal. Partners stopped investing. Retailers stopped promoting. Consumers stopped buying. What began as a call for urgent change became a market signal that the old system was dead. Stay with this story. The consequences were swift and severe. Market share collapsed. Market capitalization and future earnings evaporated. Tens of billions of dollars of value were wiped away. Roughly 90% of Nokia's prior smartphone presence was gone. The handset business was later divested. The Nokia brand was licensed and later revived in different forms. The company refocused parts of the business on networks and services. the industry landscape reconstituted around Android and iOS. The episode became a cautionary example in the economics of platforms. Human impact followed every corporate hit. Thousands of employees lost jobs. Factory slowdowns hit suppliers and communities. Millions in household and pension value were reduced. Long-tenured teams dissolved. Product groups splintered. National pride in Finland turned to shock and anger. Engineers, retail staff, and managers watched customers walk away while leadership said the move was necessary. Careers were disrupted. Regions dependent on Nokia's employment faced measurable economic shocks. A forensic reading of the sequence reveals how a single public narrative can unravel a market position built over decades. Platforms survive on partner commitment, developer investment, and retail confidence. Public signals shift those commitments quickly. A memo that framed the incumbent platform as irretrievable removed the basis for continued investment. Timing mattered. The old platform was publicly delegitimized before its replacement was ready. The ecosystem frayed in the interim. That timing mismatch compounded into irreversible value destruction. Viewed through a strategic lens, the memo operated like a Trojan horse. It publicly undercut the handset division's platform value. It accelerated partner flight. It shrank the asset that later became divested. Whether by design or by error, the effect was clear. The handset business was devalued rapidly and deeply. The documentary record is the sequence of actions and outcomes. The origin was a dominant platform. The prior warnings were evident in delayed partner investments and falling retail orders. The key decision was the public commitment to a new, immature platform. The escalation moved from sales dips to ecosystem collapse to market abandonment. The turning point was the memo's framing. The immediate consequences were mass layoffs and a rapid market share loss. The institutional fallout included divestment of the handset unit and a corporate refocus. The long-term industry effect was the consolidation of smartphone ecosystems around two dominant operating systems. The final lesson is stark and specific. In platform businesses, words are actions. A single public signal can change partner calculus overnight. Timing is as important as strategy. Killing a legacy without a ready replacement risks turning a strategic pivot into a collapse. Learn the warning signs.